Hello and welcome to this first lecture on financial markets and instruments in this course, Finance and Accounting Fundamentals. So, in this particular section, we will give you some in-depth view of financial markets and instruments. And in this particular lecture, we will talk about types of financial markets, and there we will talk about capital markets, money markets, and derivative markets. So let us look at first what are capital markets. Any thoughts? What do you think are capital markets? Now, the capital markets are the financial markets where individuals and institutions trade, buy and sell financial securities primarily to raise capital for businesses, governments, and other organizations. And these market include stock market for equity and bond market for debt. Now, what are the key functions? The key functions, the first one I would suggest to look at is that companies and governments can raise funds for growth of projects. So, for projects or the growth of projects or business growth, they can raise funds. Second, investors can buy or sell security and that provides the liquidity. So there is a place where you can go and buy and sell what you have or what you don't have, you can buy that. Third is this price of securities are determined through supply and demand dynamics in that these market work as a as a place where you can discover prices. What are some examples of these capital markets? The very familiar New York Stock Exchange, NASDAQ, uh, National Stock Exchange of India, Bombay Stock Exchange of India, and every country has these capital markets exchanges where you can buy and sell the stocks, raise capital, look at the liquidity, and discover the prices. Next, let us look at what are money markets. So money markets are again financial markets, right? Like capital markets, where short-term borrowing, lending, and trading of highly liquid and low-risk instruments take place. So unlike capital market where the stocks and bonds, here it is short-term borrowing, lending, and trading of highly liquid and low-risk investments. And this instrument can typically have a maturity period of 1 year or less, and these money markets are used by governments, banks, and corporations to manage their short-term liquidity needs. Now, what are typical key instruments that are traded or bought and sold in these places? The first is the treasury bills, right? The government debt securities with a short-term liquidity. So government raises these short-term securities which have a short maturity, less than definitely 365 days. Then there are certificate of deposit (CDs), which are the time deposits with the bank. So banks issues these certificate deposits. You can deposit the money there, and bank will give you a certificate and a appropriate rate of interest on that. And then there are commercial papers which are unsecured promissory notes issued by the company. So the three people who issue these kind of instrument, one is the government itself as treasury bill, there are banks that issue the certificate of deposits, and even the companies issue these promissory notes against which you give money to them and they give you the interest and the assurance to pay back your capital. And these are called the commercial papers. So money markets provide a way to maintain liquidity, are often used by the investors seeking safe investments with lower return in the short run. Lastly, in this lecture, let's look at what is called derivative markets. So what do you think are derivative markets? So derivative markets again are type of financial markets where the derivatives. What are derivatives? These are the instruments whose value is derived from the performance of an underlying assets like stocks, bonds, commodities, interest rates, or currency. And derivatives are often used for hedging risk or for speculative purposes because they move very fast and they're very volatile. Now, what are the common types of derivatives? First one is what is called futures, in which are the contract to buy and sell an asset. So you have an asset like a stock. Now owning that is equity, but if you have contract to buy and sell that asset, that's a derivative of that, or that's a futures. And it is a contract to buy and sell at a future date at for a predetermined price. The second was in options, which are contracts give the right but not the obligation to buy and sell an asset at a set price before a certain date. And finally, there are swaps that are contracts where two parties exchange cash flows or liabilities from two different financial instruments. So these derivative markets are essential for price discovery, risk management, and leveraging investments. So having looked at types of financial markets, what do we do next? We will look at some types of financial instruments like we started looking at, like equities, bonds, and mutual funds and ETFs in the next lecture. So thank you so much for watching this first lecture on financial markets and instruments in this course, Finance and Accounting Fundamentals. I hope you're continuing to learn new things, continuing to enjoy, and I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions. I'll be happy to answer your questions, and do download the PDF file to take a look at anything that is of specific interest to you.